Hey Brandon, it's great to have you on the channel. And before I'm talking too much, please explain in your own words, what are you doing? What's your background at Crane Shares?
Yeah, so I'm the Chief Investment Officer of Crane Shares. We're a China and emerging market focused ETF provider. We're also very active in the climate space through some carbon credit allowance ETFs. But really, a lot of my role is trying to provide a balanced, data-driven perspective on China's economy and capital markets.
That's awesome. And yeah, just as a general reminder, this is not financial advice. This is entertainment only, and we're also not affiliated, but I'm really glad to have your opinion on a couple of topics, because obviously you're very into the Chinese US listed companies, ADR market, and things that are happening. And currently, of course, the biggest topic is delisting. Could you summarize it in your own words? What's currently the status there, and how are you looking at it?
So the SEC is the enforcement agency for the Holding Foreign Companies Accountable Act, which is US law as of December 2020, which would, because Chinese law doesn't allow the auditors of US listed Chinese companies to provide their audit papers to the PCAOB, this law was passed to basically force the issue, to try to find a resolution to what's been a 10-year saga of the two sides not being able to come to an agreement. So ultimately, the SEC is the enforcement agency, and they're currently, as the companies, the US listed Chinese companies, file their 2021 annual report with the SEC. It allows the SEC to identify these companies as not being compliant with the Holding Foreign Companies Accountable Act, again, because their auditor is not allowed, due to Chinese law, to provide their audit papers to the PCAOB. They're violating this rule, which would see them delisted in 2024.
Mm-hmm. Yeah, right. And so, as your funds are largely invested in such ADRs, what are the current steps that you're taking in order to kind of secure shareholders or those who are invested in KWeb, for example?
So, we've taken this one. This was a bill before it was passed in the House and Senate and signed into law. We took this very, very seriously. And what we've done is we've begun a process of converting our US ADR exposure into the Hong Kong share classes. So many of the companies that have US ADRs are also cross-listed or listed in Hong Kong. And so in the case of Alibaba, Baidu, JD, NetEase, and Bili Bili, we no longer hold the ADR. We've converted that to the Hong Kong share class because of this potential de-risking, this delisting risk. If the two sides can't come to an agreement, we're optimistic they will, but it's something that we've taken. And so KWeb today, KWeb a year ago was about 25% Hong Kong. So you had companies like Tencent, Meituan, Kuaishou are their primary listing is in Hong Kong. But we've had many of the companies relist in Hong Kong. And so today we're up about 70% of the exposure is in Hong Kong. There's a number of companies that have relisted. So like Trip.com, Weibo, Autohome, and Baozun have relisted. We've not done that conversion. We'd like to see the Hong Kong volumes get a little bit bigger. But we also anticipate that companies like Pinduo, Duo, Full Truck Alliance, the companies that haven't relisted, that they will relist over the course of the next several months. So it's our view that we'll have the ability to be completely out of the ADRs, hopefully by the end of this year, if not sooner.
Okay, that's interesting. So basically, in other words, like if you're holding KWeb as an ETF, you currently wouldn't have to worry about the topic of what's happening with my holdings in terms of you know, the ADRs and the conversion, how the fungibility works out with Hong Kong, because you are basically taking care of that, but only to kind of 70% of your whole portfolio right now. And then we kind of would have to expect a dip possibly also in terms of the valuations, right? In the case of a delisting.
Yeah, I mean, hopefully the two sides can come to an agreement. There's clearly discussions taking place between the SEC and PCOB with the CSRC, China's equivalent to the SEC. And I think, you know, where we've become a little bit more optimistic is back on March 15th, the Vice Premier Liu He, who's really the #3 person in the China's government, you know, gave a very important speech addressing a number of issues, but he basically said, you know, this is a solvable issue and it should get solved. And so that gave, you know, really buoyed the market, you know, and you know, yes, you have that, you know, all 273 US listed Chinese ADRs are going to end up on this list. And, you know, the market's kind of, you know, come off as the SEC continues to identify these companies, but no one should be surprised. And, you know, clearly there's discussions, and this is a very solvable issue between the two. And hopefully the discussions do prevail. But and I think they will. I mean, I'm more optimistic. We've taken the more conservative approach of doing this conversion, just as fiduciaries, as stewards of our investors' capital. You know, we're going to take the conservative path. But I do think it gets resolved. You know, I certainly hope so.
Yeah, that's also generally my takeaway and views, but we'll see. I mean, you mentioned it, discussions are going on, and yesterday night we had also again a ping pong back and forth between the SEC and the CSRC. Is there anything you'd like to add around yesterday's conversation, or?
Yeah, it's interesting. So after the U.S. close, the SEC chairman, Gary Gensler, gave an interview to Bloomberg, and where he basically said, you know, we're talking, and, you know, we want to find a resolution, you know, right. You know, the U.S. side is not going to, you know, provide any special, you know, out for China, that, you know, this is a global standard. And then overnight, the CSR chairman Yi, you know, basically they released a statement where they said, you know, him and Gensler have spoken 3 times since last August, and that the two sides are continuing a dialogue and hope to find a resolution. So yeah, I mean, I think it shows that there's a talk, and I think the two sides, you know, my personal opinion is, it's not the private companies, it's not the Alibabas and JDs and NIOs. It really is that there's a small number of state-owned enterprises amongst the US ADRs, and those companies might actually have sensitive information, state secrets, that, you know, I don't see how they would end up in an audit, but in theory could. So I think if the two sides could segment the private companies from the state-owned enterprises, it allows the vast majority, you know, virtually all of the companies to adhere to the PCOB rules, and puts this issue to bed, puts investors' capital, removes a significant risk. And, you know, hopefully a broad agreement can be done, but I think a simple step would just allow the private companies who have nothing to hide, allow them to adhere. You know, that should be easy. You know, Alibaba has said numerous times, if they could, they would adhere to this standard. Yeah,
right. I mean, like, the news around this issue is like, increasing in frequency daily, right? And so, well, one thing what investors could do in catching up with those topics is reading your blog, and I have it open here. You are writing a blog called China Last Night, right? And I find that one quite interesting. And so I'll link it here. And today's topic is, you call it a buyback bonanza. And I also talked about this actually during my pre-market video today. Like, what's the news today? Weibo is buying back VIP Shop. Why are the Chinese companies buying back shares right now, and what can we make out of that?
Yeah, I mean, I think, you know, the companies clearly believe that their stock is cheap, and that these companies, have seen their share prices depressed, not only due to the delisting risk, but also due to the uncertainties around China's internet regulation. That the view by some market participants is, China is trying to kill its tech darlings. I disagree with that view, but for many investors, the uncertainty on what is the outcome of this regulation has led them to sell, come out of the stocks. So part of that Liu He speech was about the regulators in China being transparent and communicating with the market about internet regulation. And so I think there's two important parts about the buyback. One is just these companies have a lot of cash on their books. Within the K-Web companies, it's around 25% of the value of the companies are actually in cash. So the companies, they're putting that cash to work. I think what's more important is, I think what the companies are telling us as investors is that this regulatory cycle is likely over. And that is very important, that they're not going to come out and say, okay, the coast is clear. But I think there is, it's like in poker, a tell, they are telling us something. And that's the simple reality, is that the vast majority of these companies, their forward-looking PEs are 2 standard deviations below the historical 5-year average. And the companies are saying, our stock is cheap, we're going to buy it ourselves. And then I think they're telling us something about this regulatory cycle.
Yeah, and well, playing devil's advocate here, like, could this also be a hint for some taking private initiatives? Because on the other hand, and that would kind of make us investors lose out on that. They could simply say also, well, we have no future on US exchanges, let's buy back the company.
100%. I mean, and we have one smaller company. It's a small company, 51 jobs, will be taken private at the end of August. And that's exactly 100%, Marcel. It's the companies are just like, if investors aren't going to properly value us, well, we'll take ourselves private and reap the rewards. And so the go private, sometimes those deals aren't necessarily great for shareholders, that that the stocks are depressed and the buyback tends to be at a premium, but it's not at a massive premium. But I think the importance of this is that back in the summer of 2015, the Chinese A-share market, the Shanghai and Shenzhen market, rolled off very precipitously. And it had a knock-on effect on both Hong Kong shares as well as US ADRs. And I very distinctly remember, I think it was in August of 2015, 2 US listed Chinese companies took themselves private. And those deals marked the bottom. And this deal from 51 jobs, it's that shows that we're in a capitulation where a company is so poorly valued by investors that it's willing to take itself private. And hopefully that plays out, that like what we saw in the summer of 2015, that these go private deals mark the bottom. Obviously we can't predict the future, don't pretend to, but I think hopefully history does repeat itself here.
Yeah, let's hope for that. Let's see, maybe this was the button. And thanks so much for your insights, Brennan. Let's check back soon if this was the case. And yeah, thanks again for joining us today.
No, thank you for the opportunity, as always.